Can start. So good morning, good afternoon, or good evening, depending on where you are on the globe. It's my pleasure to welcome to today's webinar. Welcome you to today's webinar, which is part of the Axis Forum on Climate Change, Macroeconomics, and Finance. As a reminder, this forum aims to facilitate the exchange of ideas around climate change, its impact on the economy and financial markets, as well as on climate policies around them. And today I'm thrilled to welcome Eric Jondeau from the University of Lausanne. Eric has an extensive research agenda on sustainability, notably on the alignment of asset portfolio on the transition and the tools to do it. And today Eric will present a paper on the impact of green investors on stock prices. So as an introduction, I think this paper tackles an important questions. So how does the increase in investor using divestment strategy impact equity market? And this is an important question because divestment strategy have been at the heart of investor strategy to support the transition so far, together with engagement. And with this kind of strategy, they aim to incentivize and reward firms that work for the transition and try to accelerate it. So Eric papers will give us some insight on the dynamic and impact of such strategy on asset price and asset returns. But before we turn to the paper, let's have our traditional poll around the topic of the issue. So we have two questions. Do green investors currently have an impact on market price? No, yes, a big impact, yes, a marginal impact. And can exclusion strategy be a significant part of investors' cause? Yeah, sorry for the question. It's will the exclusion strategy play a part in causing the transition to net zero in the real economy? Yes, no, it has no impact on the real economy. No, but it can amplify other climate policy. I'll let you a few seconds to answer that, and while you answer it, let me introduce Eric more formally. So Eric Jondeau is a full professor of finance at HEC Lausanne. He is also a faculty member of the Swiss Finance Institute, and in Lausanne he has been the director of the Center for Risk Management since 2012. Eric graduated from the French National School of Statistics and Economics, in Paris. And he holds a PhD in economics from the University of Paris-Dauphine. His main research interests are sustainable finance, systemic risk, financial econometrics, macrofinance models, and the modeling asset prices. A wide range of topics, as you can see. And Eric's recent publications have been published in a variety of international leading academic journals, such as the Journal of Financial Economics, the Journal of Econometrics, and the Journal of Monetary Economics, among others. Eric has also co-authored the book Financial Modeling under Non-Gaussian Distribution in Springer Finance. So let's see now the result of the poll. So do green investors have an impact on market prices? A marginal impact, according to our poll. And yeah, a bit more balanced answers for the second question. Yes, inclusion strategy can impact the real economy. No, but the majority is that it's basically divestment strategy can amplify other climate policy or can best work when there are other climate policies. That being said, I hope it gives you some food for thought also to answer this question during your presentation, Eric. Thanks again for joining us, and the floor is yours.
Thank you very much, Pierre, for this introduction. And yeah, it's a bit frightening to see the results. I mean, it's not, it may not be a good start, but maybe this is my job to convince you that going for net zero strategies is going to be a bit more useful than you think. Maybe to start with, I just would like to introduce my co-authors. So that's a joint paper with Gong Chen and Benoît Maujon from the Bank of International Settlements, and Dimitri Vayanos from LSE. And that's a paper that follows several other papers I've written with people from the BIS on decarbonization and what kind of strategies could be implemented to reduce the carbon emissions of a portfolio. And every time we were presenting these papers, we had the same question: what is the impact of your strategies? This is fine to design, you should exclude firms from a portfolio, but at the end of the day, there's not going to be any impact because if you as an institutional investor, you decide to sell your shares, there will be somebody else on the other side that will buy these shares, and at the end of the day, the impact is going to be marginal. And I think what you had in the poll is precisely reflecting this phenomenon. There will be somebody on the other side. I think this is true if there is a sufficient number of investors on the other side, and it may be different, and that's my guess. It may be different if there is an insufficient number of people on the other side ready to buy your shares. And that's precisely what we describe in this paper. The idea is really to describe what would happen if the proportion of passive investors on a financial market is going to be relatively large, and you won't find so many people ready to buy your shares. So this is the objective for this paper. So maybe to start with, the starting point is really to talk about this recent trend in growth in green investment. And usually we have these two main motivations for green investment. It could be either for carbon risk hedging or for impact investing. And actually, I'm more precisely focusing on impact investing. And in the recent years, we have had these initiatives, maybe from the corporate side or from the central bank side, to promote net zero investment. The motivations can be quite different. I mean, you may want to divest or exclude firms from your portfolio. So that's the idea we started with. But you may go through engagement or voting and as a way to keep the shares in your portfolio, even for relatively highly polluting firms, with the idea that maybe you're going to manage to convince the top management of the company to change. Of course, you can also invest in green bonds, and in this case, you can invest in any kind of firm, but in principle, you're going to have a limited impact on emissions. In the recent years, we have seen the development of these green indices. And if you know a little bit about the new regulation at the EU level, this is essentially the logic of this Article 9, or the dark green, if you prefer. So this is the logic of investing in a portfolio where you're going to have progressively a reduction in the carbon footprint of this portfolio. So one way to invest in this way, so tracking a green index, it can be static. So the logic is just you're going to define an index whose carbon emissions is going to be, let's say, 10, 20, 30, 40% below the standard index. But there is also a more proactive way to decarbonize a portfolio. That's what we call net zero indices. And in a net zero index, the logic is to progressively reduce the carbon emission of this portfolio by excluding, over time, more and more brown firms from the portfolio. And actually, you have quite a lot of such net zero indexes. One example is the one here that you can see on the slides, the green S&P 500 Paris Align Index. If you look at the data on, from Morningstar on precisely on these Article 9 funds, so the dark green funds, the current number of funds that can qualify as Article 9 funds, you have 280 over 780 of such funds. So with a carbon reduction objective, so this is fine. You could say that okay, so it's not that a big number, and probably I would agree, and I would say for the moment it's still a kind of a niche, and probably that explains this relatively pessimistic view you presented in the poll. So what is the objective now for this paper? So we argue that there is a price impact on, let's say, a substantial price impact of green investment if you go through an exclusion strategy, in particular net zero strategy. So the first question we ask is how big it could be. The second question is where does it come from? So what is the initial source of this price impact? Then what about the timing? So if you invest in a net zero strategy, you're going to have progressively less and less highly polluting firms. So when does it start to have an impact on prices? And I think that's important to understand this particular timing question. And finally, what about the realized return? So if you invest in a net zero strategy, usually what people would argue is, okay, so you're going to lose money because you know, green investors don't want to invest in brown firms, and brown firms have to pay a premium to attract new investors. So the compensation for this willingness of green investors to divest from brown firms is going to be, you know, you're going to make more money if you invest in brown firms than in green firms. Actually, what we argue is, okay, so it may be a bit more complicated than we think. So these are the research questions I would like to describe. And before I give a flavor of the answers, I just would like to very briefly introduce the model. You know, what we argue in this model. The first point, and I think that's a really main reason why we can obtain different results from the literature. We have three types of investors. So of course, we have the usual active investors, and these active investors are really important because they are the investors who will be willing to buy the shares you want to sell. So if you are looking for a counterpart to buy the shares that you want to sell, you need active investors, and these active investors are absolutely key in this logic. And we have these active investors. What is a bit more interesting is we also have passive indexers. So these are investors who just track a market index. Okay, so it may include the pure ETF funds, if you want, or pure indexers, but it may also be the case for some active investors, but with a very tight tracking error. So typically, institutional investors are usually in this category. So the room for passive investment is relatively big, and I think that's an important point. Finally, we have green investors. Okay, and these green investors are going to invest in a green index with a net zero trajectory. Okay, so the logic of this green index is going to be to reduce the carbon emissions of the portfolio on a regular basis, and I will describe a bit more precisely how it works. So what we do then is to calibrate a dynamic equilibrium model, and the main logic of the model is described in this paper by Vayanos and his co-authors in the GP. And you know, the logic is relatively simple. I will describe this logic in a few minutes. The technology behind is a bit more involved, but the logic is quite it's quite natural. So in the model, we describe three sources of risk for firms. The first one is let's say the usual systematic business cycle risk factor. The last one is the idiosyncratic risk, and in between we have some other systematic source of risk that we call the climate transition risk. This climate risk is introduced only in one of the scenarios we wanted to investigate, which is, what if it is costly to or risky to invest in highly polluting firms? Okay, so when we start, I mean, we don't assume any particular risk in brown firms. We just say, we want to divest from these firms because they are polluting too much. And finally, the way we solve the model is to get the equilibrium prices from the state variable. So I will describe this mechanism in a few minutes. So the main logic of divesting from a portfolio, you can see on the top of this slide, you have the green investors portfolio, and below you have the active investors portfolio. The passive investors, they are out of the story because they don't buy anything special, but the regular stock market index. So what happens? You can imagine what are these different categories of firms. So you have the green component of the portfolio. So you have the green firms, and then progressively you have more and more browner firms. So these ones at the top are the ones with the higher emissions. So the green investors want to divest from these firms and invest more in the green firms. Okay, so the way it's going to work is that the green investors are going to look for active investors willing to buy their brown firms and willing to sell their green firms. Okay, so there will be a kind of a bargaining between the two categories of investors, green investors and active investors. Okay, and the first year, so this is year 0, where you have the same investment in all categories. And the first year you start to reduce your investment in the brown firms as a green investor. And after a while, you're going to have no brown firms. You go to the next category. And we can imagine that at the end of the period, so at the end of the implementation of the net zero strategy, you're going to have only green or almost green companies in your portfolio as a green investor. And the active investor is going to have exactly the counterpart in some sense. So it's going to have the brown firms and the little bit less brown firms. Okay, so this is the logic. And as you can see, I mean, what matters at the end of the day for this rebalancing of the portfolios, passive investors, essentially, they don't play any particular role in this exchange of stocks. But at the same time, the relative weight of green investors versus active investors is going to be absolutely fundamental. Okay, so what will drive the main impact on prices will depend on what is the relative fraction of these two categories of investors, and that's precisely what we're going to focus on in this paper. So to give a very brief review of the results. So what about the price impact? Is it big? So the answer is yes, it can be relatively big. So what we find is that the impact on prices can be somewhere between 5 and 10% decrease in the price of brown firms for what we would argue is a relatively realistic calibration. And I will tell you what I mean by realistic calibration, but this is essentially what we can observe on financial markets. Where does this effect come from? It comes from the fact that active investors, they have to absorb the additional supply of brown shares coming from the green investors. And if the weight of active investors is relatively low compared to the weight of green investors, the price impact is going to be amplified. What about the timing? So I think the timing is relatively important. And in particular, because as soon as the net zero strategy is made public, people will know that at some point every year you're going to exclude some new firms, and we know what are the most polluting firms, and essentially the plan is almost already known. It's not exactly perfect foresight, but that's almost the case, right? I mean, if I give you the carbon emissions of the firms in the S&P 500, for instance, you probably you would know what are what will be the first firms to be excluded and the next ones and so on and so forth. So the price impact is going to show up essentially at the beginning of the implementation of this of the net zero strategy, which means that there will be a kind of a first mover advantage for green investors. And finally, and I think this is an important question as well, that's about the realized return. So at the end of the day, what is the relative performance of green investors versus normal investors or active investors? And actually, what we can measure is at the end of the implementation of the strategy. So we assume a 10-year net zero investment strategy. After the 10 years, the realized return of the green portfolio, so the investors, green investors investing in green portfolios, essentially, the realized return is going to be higher than the realized return of the brown portfolio. Okay, so it may be a bit weird because it's always the same idea that you know, the risk premium is going to be higher for the brown firm, so they're going to pay more and they're going to compensate investors. This is true, but if the price impact is big enough, the higher premium for brown firms is going to be compensated by this price impact, and that's exactly what we observe. So I'm not saying that at the equilibrium, the compensation is going to be lower for brown firms. There is no question about this. I mean, the compensation will be higher, but the price impact can be relatively big and compensates this higher cost of capital. So I don't want to be too long on the literature, and I just would like to mention that there are different fields of the literature on this question of the price impact. So one set of papers is about the implementation of net zero carbon portfolios. So I have contributed with my co-authors from the Bank of International Settlements to this literature, but of course you probably know the Bolton and Kasperczyk papers, and they're also proposing some alternative ways of decarbonizing a portfolio. On the more theoretical part of the story, I think the importance of demand shock can be relatively big, and I think the demand, so Koyen and Yogo in particular, have contributed a lot on this literature. For the price impact, more specifically, I guess the most famous paper is this paper by Berk and van Winsbergen. I think that's really important to understand that we precisely try to understand what is behind their result. Their result was to say there is absolutely no impact, or I mean the impact is so marginal that you can forget it. So I think it has that. I mean, there was a huge impact of this paper in the mind of most people interested in these decarbonization and net zero strategies. And I think it's based on a web principle that, you know, whatever you sell, there will be somebody else willing to buy. And I think the main difference between their paper and our paper is precisely that we don't assume that there is a infinite demand on the shares we want to sell. So I'm done with the introduction, and I'm going to go through the model. So there are 40 pages of description of the model. I'm kidding. There is only one slide that I would like to summarize. So this slide is designed to summarize what you have, or what is the main logic of the model. And I think the important thing is really to understand how the model works. And if you are interested in the details, you will find the details in the paper. But given that I have limited time, I think it's better to give a brief overview. So we can start from two sides. So the one is what is the theoretical description of the price dynamics, and the second side is what is the behavior of our investors. So let me start with the price dynamic. So the way it's working in this model, and this is the main logic as you can find in the Dimitri Vayanos papers. The the starting point is the dividend dynamics. And in the dividend dynamics, you assume some risk components. So here you have the systematic component of the dividend flow. Here you have the climate risk component of the dividend flow. And here you have the idiosyncratic component of the dividend flow. Okay, so we have these three components that contributes to this dividend flow. And what is relatively key in the in solving the model is the assumption of a square root process. So which we assume some particular dynamics in the dividend flow. Once we have these dynamics for dividends, we can extract the price dynamics, and essentially by just using the logic that the price is the discounted value of future dividends. And here the price dynamics is going to be composed of these three very same components, so the systematic, climate risk, and idiosyncratic components. And we have that the price components are going to be functions of the dividend components. And what we assume as a conjecture is you're going to have affine functions here for the price dynamics. Under this specification, we use the Ito's lemma to find the share return of the shares. Okay, so this is a return for stock N on day T. Okay, and this share return is given by the dividend flow on one side and the price change on the other side. And you can see, of course, that there could be a kind of a trade-off between the two components. Finally, given this dynamic for the return, we have the expected return dynamics, and it's just the expected component of this part. And you can see that if you follow these different steps, you can see that the expected return is going to be a function of the price dynamics. So you have the dividend parameters that will play a role, and the parameters of the affine functions for the price dynamics that will play a role. Okay, so at the end of this step on the price dynamics, you have the expression for the expected returns for the different shares. If you go on the other side, for the investors' behavior, so we have the three categories of investors. So we start with passive investors. So they are pure indexers. So the way we solve this behavior of the passive investors is they just maximize their mean variance utility, but they can invest only in two portfolios. Either we hold the risk-free asset, or they invest in the broad index. For the green investors, you have essentially the same logic, and you have the same optimization program where you maximize the mean variance utility, and you invest in the risk-free asset or in the green index. Finally, you have the active investors' behavior. They incorporate the information about the dividend dynamics, so their utility is conditional on the dividend flow, so they want to incorporate all the information that we can observe. So the supply and demand is going to play a role for the active investors. And what they do is just to maximize the conditional expectation of their wealth minus the risk aversion divided by 2 times the variance on day T of their wealth. We compute the first order condition of this optimization program. We impose that markets are going to clear, and combining these two things tells you that the expected return for the firm is going to be the risk aversion times the stock contribution to the portfolio return variance. Okay, and now we have these two equations. So one coming from the price dynamics and one coming from the optimization behavior of the different categories of investors. And by identifying the two processes, that's how we find what are the price parameters. So this is a fine function that I have assumed here. We can extract the parameters of these different functions. And finally, we obtain the optimal weights. Okay, so that's how we solve the model essentially. So now how do we parameterize the exercise? So we assume essentially that we have 500 stocks. So we could be inspired by the S&P 500. So we have 500 stocks. We assume that we have 100 groups of 5 stocks, and these 5 stocks are in the same category of carbon emissions. Okay, so you have one portfolio of 5 stocks that is extremely polluting, and the next the next group is going to be a little bit less polluting, and so on and so forth, until you have essentially no emissions for the last group. What is a net zero strategy we implement? We start the first year, we exclude 1% of the most polluting firms. So we exclude the first group of 5 stocks from our portfolio as a green investor, of course. So we exclude the first 1% of most polluting firms. So this is the first year. Second year, we exclude the second % of the most polluting firms, and we do this for 10 years, which means that at the end of the 10 years, we have only excluded 10% of the firms. So it's not an extreme rebalancing of the portfolio. I mean, it's relatively limited as a net zero strategy. I mean, what I would argue is that it's probably sufficient to reduce the carbon emissions of your portfolio by more than 50%. So it looks a little bit limited, but the impact would be relatively big. And of course, the reason why we have this big difference between excluding a small fraction of firms and having a big impact on the carbon emission is because the carbon emissions across firms is extremely asymmetric, with a small number of firms emitting a lot of carbon and most of the other firms emitting a very limited amount of carbon on average. For the rest, the stocks are going to be symmetric. So the only thing that could play a role is the carbon risk that I'm going to introduce in the last scenario I'm going to tell you. And for the rest, I mean, we calibrate almost all parameters just to match what we observe on financial markets. So typically, we want the firms to have, on average, the expected excess return we observe between 4.5 and 5%. So it's going to help us to calibrate the number of shares and the risk aversion parameter of the investors. And we also impose what we observe in terms of relative risks between systematic versus idiosyncratic risk, and this relative weight of the two sources of risk is going to be selected to match the CAPM R-square that we observe. And what I'm going to show you are the impact that we observe on the moments. The final step before I show you some results is the calibration of the relative share of the different types of investors, and I think that's really the key in our results. And yeah, I think that it deserves some words. So the first point is the weight of passive investors. So we assume 50% weight for passive investors. I think it's quite well known that nowadays on financial markets, the passive investment strategy is predominant. At least in the US, there have been some numbers provided by Bloomberg on the weight of the equity index mutual funds and ETFs. They do represent now more than 50% of the US equity mutual funds. So it's not the complete market, but it just tells us that the weight of, or the share of passive investment is relatively big now. If you are interested in green investors, so we had quite hard time calibrating these numbers. So we picked this number of 30% of green investors. So I think it's relatively big. It's consistent with the numbers provided by the Global Sustainable Investment Alliance, and they find 36% of sustainable assets under management. I think it's probably a bit too optimistic. But at the same time, I mean, if that's too optimistic, so let me be a bit more optimistic and think that if we implement this kind of net zero strategy, the weight of green investors is going to increase. So now I'm going to show you some results. I'm going to show you results based on these three scenarios. So in the first scenario, that's a basic scenario where everything is going to be static. So we're going to have 30% of green investors, 20% of active investors, and 50% of passive investors. And then I'm going to consider some scenarios where the share of green investors is going to increase over time. Okay, and it's going to increase from 30 to 60% of green investors. So every year you would have a little bit more green investors starting investing in this net zero strategy. In the final scenario, scenario 3, what is new is what if you have a climate risk factor affecting the dividend flow? So what if it is risky to be exposed to transition risk? So some results. So this is scenario 1. So you have 30% of green investors, 20% of active. So the balance between the two is more or less okay. I mean, you would probably find some people willing to buy the shares you would like to sell. If you look at the price impact, so in the first panel you have the price for the firms that will be excluded the first year. So these are the most polluting firms on the financial market. The second panel in the middle is going to be the last group of firms that will be excluded. So they are in this 10% of the most polluting firms, and it's going to be the less polluting of the most polluting firms, if you want. And finally, the last panel is what about the price of the other firms? So they are not polluting enough, if you want. So they are, I would not say they are green, but they are not excluded from the portfolio. The red dot is going to be the starting point, so that's the ex-ante number, and the blue line is going to show you the trajectory over time of the price for the different categories of firms. You see that for the most polluting firms, the price is going to jump instantaneously. So at the time you announce that you're going to invest in this, or you start the net zero strategy, the impact is going to be relatively big. So it jumps from 7.7 to 7.2 or 3. Okay, so it's relatively big. For the other firms that are going to be excluded over time, so it's known in advance. As I was saying before, I mean, once you have a sufficient number of people investing in the net zero strategy, it's going to be relatively obvious what would be the different categories of firms that will be excluded. You may imagine that some firms are going to improve their production process over time, but okay, so it's going to change a little bit, but you know, the impact would be probably similar. So for these firms that will be excluded last, the instantaneous price impact is going to be lower. Okay, so the decrease in price is going to be lower, even if after the 10 years of the implementation of the net zero strategy, you're going to have a similar impact on prices. Finally, for the companies that are not excluded from the net zero portfolio, there will be a little increase in price. Okay. What about the cost of capital? So the expected returns that firms will have to pay to the investors. That's exactly the opposite that we observe. Huh? So for the most polluting firms, the expected return is going to jump from 4.76 to 4.9. Okay, so they have to pay more or to compensate more their investors, and it's going to be, of course, beneficial to the active investors. For the intermediary companies, you have a jump, but it's going to be more progressive. And for the not excluded firms, so the clean ones, the impact on the expected return is going to be negative. So it's going to reduce a little bit the expected return they will have to pay. Okay, so if you look at this picture, it would be clear, and that's the usual way of thinking. It will be clear that investing in brown firms is going to generate more revenues than investing in clean firms. So here you have a summary of the main results, and I just would like to emphasize these numbers. So for the films that are excluded first, the price impact is relatively big. So it's minus 5.6%. It's slightly positive for the non-excluded films. The cost of capital is positive, and it's close to 0.2% for, so 20 basis point if you prefer, for the most polluting films. It's slightly negative for the non-excluded films. And overall, so when you accumulate these two effects, and you value your portfolio for the next 10 years, the impact for the returns that will be provided by the most polluting films is going to be 4.4%, but it's going to be 4.8% for the non-excluded films. So when you aggregate these two mechanisms, so the price impact and the higher return for the most polluting films, you can see that it's not completely clear that at the end of the day, it would be, you would generate more revenues by investing in brown films. So there is I think there is an important thing to mention, that the difference with the Berk van Binsbergen paper. So in their paper, the increase in the cost of capital is really marginal. So it's 0.0044%. So you could argue that it doesn't matter. I think it's important to realize these important assumptions that we have in this paper. So green investors, they represent only 2% of the market, and the rest of the market is going to be active. So the 98% of other investors will be willing to buy these shares that the 2% of green investors want to sell. Okay, and that's a key difference with our model, where the fraction of passive investors is going to be big. So our effect is 0.2%. Okay, so it's not super big. It's 20 basis points in terms of cost of capital, but it's 45 times bigger than the increase in the cost of capital found by Berk and van Binsbergen. If you look at the reason why you have these differences, that's essentially due to this difference in terms of share of the different categories of investors. So our green investors, they represent 30% of the market, but what you have on the other side, the active investors, they are not 70%, they are 20% in our main case. So you may ask yourself, okay, so what if we change this relative share that we made? So here we did exactly the same exercise, but varying the share of green investors. So the main case, this is a 30% here. Okay, so that's essentially what I reported before. If you want to have less green investors, and you ask yourself, okay, so what would be the impact on prices if we had, let's say, 10% of investors? If we had 10% of investors, of course, the impact on prices would be much smaller. So that would be close to 1.5% decrease in the price of brown films, which I think it's not marginal. It's not that big, but it's not marginal. Of course, you could, I mean, if you increase the share of green films, green investors, you're going to have a bigger impact. Pierre, should I understand that I have to be a little bit faster?
If you, we want to keep question for the answer, so if you can.
Okay. So let me
conclude,
be a bit quicker. Yeah. Okay. So I'm going to switch this. So this one is on the realized return. So what I wanted to emphasize is at the end of the 10 years, you don't really suffer from a lower expected return lower realized return for the green investors. So we have this compensation between the price impact and the higher expected return. If we go to the case where you have an increase in the share of green investors, you can see that the price impact is relatively big now. I mean, it's close to 10% decrease in the price with a larger cost of capital, of course. But at the end of the day, the difference in terms of realized return is going to be even bigger than before. what we need to have this compensation effect to be less pronounced, that's a case where you have a climate transition risk that should be taken into account. And that's this is my final point. It's going to be relatively important. So if polluting firms are exposed to this climate transition risk, active investors, they know that these brown firms are going to be riskier. For the moment, I mean, so far, it was just, you know, I'm going to invest in bond firms because they will pay me more. Now, if these bond firms are exposed to climate risk, it's going to be a little bit riskier for active investors to invest in these bond firms, right? So they will be more reluctant to invest in the bond firms. So they will have to be compensated more. And that's exactly what we observe in this last slide, where this is the same story, but with a climate risk. And you can see that the cost of capital now is relatively big. So the price impact is big, but the cost of capital is increasing quite substantially because of this additional climate transition risk. So at the end of the day, what you can see is that the difference between the realized return of the two categories of firms is almost zero. So at the end of the day, it's relatively close to zero, and that's due to, you know, it's riskier to invest in brown firms, so active investors will have to be compensated more. So I'm going to conclude now, if you want, and just to say that the price impact can be relatively big in the financial markets, where you have a large share of passive investors. You don't have this systematic compensation of, you know, if you sell, somebody buys. And the price impact can be, let's say, between 5 and 10%. The cost of capital is between 20 and 50 basis points. So it's not super big, but at least it's not negligible, as found by Berk and van Bitsbergen. And the main reason is the imperfect substitution between the brown and green assets. That's due to this limited share of active investors. So this relative weight between active investors on one side and green investors on the other side is really key. So if you divide by 2 the share of active investors, you're going to multiply by 2 the price impact. So we have the first mover advantage, where you can see the first year, directly the first year. Once we start the net zero strategy, the price impact is going to be super big, and that's it's happening the first year. So we have these properties that we need to understand a little bit more of the first mover advantage if we decide to invest in this net zero strategy at an early stage. I would not say that we are too late. I think we are still on time to be among the first to invest in a net zero strategy. So I would recommend institutional investors to go for this. And of course, what we don't incorporate in the model is the feedback effect of the increase in cost of capital and its impact on bond firms. So maybe the effect is going to be amplified, because brown firms are going to go greener because it's less costly. So I'm done, and thank you very much for attending this presentation. I will be more than happy to answer questions.
Thanks a lot, Eric. So if you want to ask a question, it's the right moment. You can write in the Q&A section, and I will either call you out or read the question to Eric. So while you thinking of a clever question, let me ask by one for myself. So some of the biggest investors are passive, as you say, and here I have in mind, for example, central banks that also invest in equity. Usually they are passive investors. I'm not sure I've seen the consequences for them of being passive compared to active. And do you have some insight on that, on the return, but also on the volatility of their portfolio? Does that change anything for them?
Actually, so this is I have to recognize that we didn't go you didn't focus really on the passive investors. We just assume that okay, they don't want to make a decision on being green or not. So okay, so they are left aside. I think the impact at the end of the day is going to be limited on these investors. I mean, there will be this kind of compensation between the two categories of assets. If you look at the numbers, I mean, the difference in terms of performance is in particular in terms of realized return, the difference in terms of performance is relatively limited. So there is a smaller, larger loss for the brown firms. At the same time, again, the brown firms, they represent a small fraction of the financial markets, right? At the end of the day, at the end of the 10 years, only 10% of the bonus firms have been excluded. So the impact on a passive investor is going to be limited because of this limited fraction. You know, their portfolio is not going to be changed that much. But they don't make a decision, huh? So they keep exactly the same weight in the index, in the global, in the standard index.
So there are a few questions in the Q&A. So one is relatively technical about using a quadratic mean variance utility function for, and then would that drive the results? Like if you think that like skewness can also, for example, change the results, that's relatively technical. Yeah, and I'll let you maybe answer that if you want.
Yeah. So essentially, you know, all the assumptions we have in the model are going to have an impact on the results of using the model. So yes, it's quite clear that it's going to have an important impact. I would probably agree that the risk aversion parameter is probably an important component. So we didn't want to focus on risks. It may have been interesting to go a little bit more on the risk side of this portfolio. So what we did is essentially we assume a relatively low risk aversion parameter. So the investors, in particular the active investor, looks at the expected return to make a decision. So that's an important ingredient. So you know, we didn't want to push a result too much in our favor. So by saying, you know, you are not interested in the active investor is not interested in the performance of the brown firms. So if that was just for a risk purpose, even the active investors would not be super enthusiastic to buy the brown shares, right? So we took a low risk aversion parameter to push the active investors to buy these shares. So I think that's the main, in terms of design of the utility functions, that's probably the main assumption we make to take a low risk aversion parameter. Regarding non-normality, so we didn't go through the season non-normality story too much. What we do is through the climate risk, the climate risk factor. So actually, what we do is that we calibrate. So in the third scenario, scenario 3, we calibrate the impact of the climate transition risk by looking at the asymmetry. So I'm back to the skewness you mentioned in your question. So we look at more specifically the asymmetry we observe in carbon emissions. And you know, that's something we can easily observe, that you have a few firms with extreme emissions, and our assumption was the exposure to this climate transition risk is going to be more or less proportional to this asymmetry. So assuming that the extremely polluting firms are going to be very much exposed to this climate risk, whereas the cleanest firms are not exposed at all. So which means that the climate transition risk, so when we introduce this component in the dividend flow, this climate transition risk is going to play a big role for the most polluting firms and a marginal role for the others. So that's where we have this kind of asymmetry playing a role. And actually, if you compare the results for scenario 2 versus scenario 3, that's exactly what you will observe. So the impact of this additional source of risk. And essentially, what is the impact? The impact is to increase the compensation required by the active investors. They want to be paid more to invest in these firms, in the brown firms, because they are riskier.
Maybe one question on my side. I don't know if you have insight on that, but so basically you're linking the green index as a function of only emission. In reality, like if you take the SP 500 Paris aligned, is emission the only thing that is reflected in this index, or do they, I don't know, use, for example, transition plan? Or do you know what kind of index there are on the market currently?
So yeah, so I was looking at the net zero strategies. I mean, in particular, the index is proposed in the context of these Article 9 funds under the EU regulation. So in the EU regulations, what you are supposed to design as a portfolio is a portfolio where you're going to instantaneously reduce by, let's say, 50% the carbon emissions of the portfolio. And then every year you're going to reduce by 7% at least the emissions of your portfolio. So it's cumulative, of course. So in principle, the logic that we can read in this regulation is it's essentially driven by reduction in carbon emissions. Now, as you say, I mean, there are different net zero strategy indexes that have been proposed. If you look at the fact sheet of these indexes, so I've went through the through this fact sheet, and yeah, it's a bit trickier than just saying, I'm going to reduce my emission by 7% per year. So you have a lot of additional restrictions on how you can design this index. You have restrictions I think almost everywhere. So it's a very restricted optimization problem. So you have restrictions on, you cannot increase the weight of a given share more than a fraction of the current weight. You have sector restrictions. You have ESG criteria entering in the selection process, which is a bit, I mean, I don't clearly see the point of doing this. I think you also have some restrictions on liquidity. So it's not a pure. So if your question was, is this kind of green index a pure pure net zero strategy? I think the answer is no. It's a bit trickier.
Thanks a lot. We have reached the hour. There are two questions remaining in the chat. I'm sorry not to take them. But thanks a lot, Eric, for this very insightful presentation.
Thank you very much.
I was convinced in advance that this has an impact, and I hope it will be interesting to see the result of the pool now after your presentation. Before we could just let me just remind the audience that our next webinar will take place on Tuesday, June 18, where Zacharias Sautner from the University of Zurich will present his research on do investors care about biodiversity. We're also looking forward to see these results. And before closing, thanks again, Eric, and I hope to see all of you in the next webinar on the axis. Thank you very much.
Thank you.
I think you can stop
Okay,
recording.
Pierre. Thank you. We still have a few participants on, a couple of questions and something in the chat.
Let's close down.
Okay.
Okay.
Okay, well, thank you very much, and we'll see you again in another webinar.
Thank you. Bye-bye.
Okay, thank you. Bye-bye.